Everybody, welcome to day 2 of Trustless 2020. I'm here with Abraham Sutherland from the University of Virginia. He's an adjunct professor there in the law school, and he will be talking to you today about the economics and taxation of block rewards and getting all of the terminology correct. So take it away, Abraham.
All right, thanks. My name is Abraham Sutherland. As mentioned, I'm a lawyer, and I've been drawn to and studying some of the regulatory aspects of cryptocurrency, but in particular proof of stake, and with a focus on some taxation questions, which I've heard have been raised and mentioned a little bit in some of the previous sessions. But this is a practical event, and we're focusing on practical action and ideas. So I do want to keep it concrete. The focus here is on getting the terminology right. And so what I want to do is convince you that it's really important to do so, and then I'm going to kind of come back to it and explain why it's so important. But I want to start off with some ideas there, so you can have in mind and to keep it concrete. The puzzle with proof of stake is that because the rights to create blocks are distributed in accordance with one's stake, it introduces a concept and a whole way of looking at it that simply doesn't exist in proof of work. Because one's rewards through the participation in this can be measured or compared against your stake, it very naturally leads to a way of discussing this process, which quickly involves some of the words on the screen there. So we often hear things about these rewards and measuring one's stake, and in terms of the things like the yield that comes from that. Sometimes we hear the return, even the return on investment. And when we're talking about these block rewards and reward tokens that accumulate, it's easy to describe these as passive income. And then you'll also hear references even to interest and to dividends. And what I want to highlight in the whole purpose of my talk here is to emphasize the importance of getting this terminology right and why it's so important. And to make it real concrete, I want to put this out there right now, and then I'll come back during my talk to explain why it's so important. And the most practical thing I can do for you as potential stakers and others in this ecosystem, people working on protocols even, is to recommend don't call these things interest, don't call them dividends. And the short answer is that they're not interest and they're not dividends. The longer answer I'm going to have to come back to and explain why this is so critical. And in short, those reasons are public education, and we want to give and you as stakers want to give the correct message and the correct understanding of what proof of stake is and what this validation process is and the delegation process is. And it's really important to get that right. And the second reason has to do with public policy and the regulation of and the entire regulatory environment, and in particular the taxation situation. Getting this terminology right ends up being very important to this bigger picture of making sure proof of stake is properly understood, not just by the public, not just by retail, either investors or others who are interested in proof of stake cryptocurrency or cryptocurrency in general, but also for the government itself. To get to why a good understanding of why these rewards are not interest or dividends, I want to offer a way of thinking about the basic economics of proof of stake validation, and that is to think of it as that all token holders of a particular cryptocurrency pay for network maintenance, because the new tokens from block rewards dilute their stake in the network. And simultaneously, these validators get paid for performing that network maintenance as these block rewards increase the validator's stake in the network. So in other words, block rewards serve and it's useful to think of them in this way, as transferring stake in the network away from all token holders and then putting it in the hands of validators. And what's important about proof of stake is that because these block rewards are distributed by definition among those who have a stake, both the token holders who are affected and the validators who benefit from this redistribution are in part the same people. So you end up, in a sense, transferring stake to yourself. And to see why this is so critical, look at the example here. Imagine a very simple hypothetical cryptocurrency where there's a 10% token creation rate, or you can call it a 10% inflation rate. That means at the end of a year, you're gonna have 10% more tokens in existence. But in this case, in this hypothetical cryptocurrency, everybody's a validator. Everybody who owns tokens participates and shares in that distribution and that creation of 10% of tokens. So at the end of the year, what's the situation? What do we have? Well, everybody in that network will have 10% more tokens. So the question is, how has their position changed, and how would we describe that? Well, depending on how we use the word yield, we can indeed say that participating in validation in this system has yielded 10% more tokens for everybody involved. On the other hand, it's pretty obvious here that everybody's stake in the network, everybody's percentage share, everybody's interest in the overall value represented by this universe of tokens has stayed exactly the same. And what's critical here in this limiting case is to see that nobody has been made better off. Nobody has gained in any real sense. Nobody has received interest or a dividend in the sense that those words are commonly used. And we'll get to this later. We should hope that they also did not receive any income. And if this is a little bit difficult to believe, or kind of get your head around, or it could be in part because we don't really think of cryptocurrencies in this way, in part because of volatility. Prices go up and down. So it's hard to see. We say, well, why would certainly over that year, people's value in the network, if they've got 10% more tokens, might have gone up, might have gone down. That's true, but we can abstract away from that because there's no reason to assume that the value of that network is going to go up by 10% simply because there are 10% more tokens. And that's critical to understand. And if that's hard, another way to look at it is to imagine that what if the token supply doubled in a year or even tripled? Now that's probably a bad idea for a lot of different reasons that we don't need to get into. But in that case, you could imagine that the value of the network stays roughly the same. People have 300% more tokens, but they're no better off. And the point here is just to appreciate that tokens do not equal stake, and that therefore the word yield, as we commonly use it, doesn't necessarily mean much without further explanation. What matters in this case, what matters in proof of stake is your stake in the network, not simply the number of tokens. And again, one further way to think about this is imagine a protocol which says that on February 5th we're going to add a 0 to the balance of everybody's token accounts. So suddenly everybody has an order of magnitude more tokens. What has changed? Well, you could definitely say people have more tokens, but still everybody would have the same stake in the network. So I've given you the limiting case where nobody's actually made better off, but to make it a little more concrete, I'm going to talk and use the example of Tezos. And I use Tezos for two reasons. It's very good as an example for two reasons. One is its token creation and token issuance policy is very simple. And second, it has a very high participation rate in validation, and that helps make the points a lot clearer and easier to grasp. So the way Tezos works is these new Tez are created along with each block. That's about 80 a minute, or up to 80 a minute, and then that's over 100,000 a day. And the way it works out to about 42 million a year. Now, against the backdrop of how many tokens there are on the network, about now that translates to a token creation rate of about 5%. The validation participation rate is about 70%, or a little higher than that right now. It doesn't really matter for this example. And And so what that means is, given that 5% increase is shared by approximately 70% of the validators, or the validators owning those 70% of the tokens, to be more precise, is that people end the year with about 7% more tokens. Now that's true, and in that sense, you could say that participating in validation has yielded an increase in one's tokens of 7%. However, it is not the case that they have received something equivalent or even remotely equivalent to a 7% interest or a 7% dividend, because their 7% gain in tokens is offset by that increase in the total token supply of 5%. And what that means is the validator's actual gain from validation is closer to about 2%. Now, these numbers are complicated, and the math is a little more complicated than this suggests, but it comes out to about 2%. What's the importance here? Well, first of all, the fact that the actual gain here is only about 2%, is not necessarily a bad thing. And I'm saying here, one of my points is it's very important for the public and for everybody to understand that that's actually what's going on. And I think we're all familiar with kind of the loose language used around proof of stake, and as it's developed, people talking about the returns to be had, and including with Tezos' reference to this 7% figure. And the point we're making here is that this can be misleading. The figure there of 2% is not a bad thing. It's not a bad thing for how it works, and that's a deeper question about what the ideal inflation rate might be. But it's important to realize that, as we said before, the security in a network is paid for those people whose tokens are diluted by this process, and so there's a balance to be had there between the amount that is paid by non-validators in the form of a dilution of their stake in the network. So why is this so important? Why is this worth me emphasizing to you as you're considering going out and developing a staking business or getting into it? It's 2 points. First is in general, public awareness is critical, and it's important that those involved in this, particularly stakers, but also obviously protocols and others who are involved in this at a high level, lead by example and provide accurate and informative and not misleading information. And I've just put a quote here from a Wall Street Journal article to indicate that this really is a challenge, because no less than the Wall Street Journal has written about, in a very misleading way, using the term interest when referring, in particular in this case, to the Tezos protocol and the system of delegation and so on. So this is to illustrate that this is a real concern. So that's point number one. The second reason it's important has to do with my real focus in this area, which is the issues in public policy, and in particular taxation. This entire cryptocurrency world, and especially proof of stake, is definitely new. It's definitely confusing. The economics are definitely tricky, and it's not immediately understood how it works. And I've been talking before about the importance of having people understand the true nature of the gains that are available from participating in validation. But it's also critical that the messaging is correct and that the right language is used in order to address correctly the public policy issue. And that issue really comes down to, at this point, the most immediate and important issue for proof of stake is the issue of the taxation of these block rewards. So this is a global issue. This is I saw a question pop up about the United States. I'm taking this from a United States perspective, but the economics of proof of stake are obviously universal, and this is an issue about taxation that pops up in every jurisdiction. I'm focusing on U.S. law here just because I know much more about it, but keep that in mind, that this is not any jurisdiction that's interested in taxation or regulation in general. You're going to confront this issue, And the United States approach to it is a good introduction. So the IRS in 2014, as many probably know, stated that mined virtual currencies are gross income at the time received. Now, this was written, obviously, in an era of proof of work, but the majority opinion today, and also the conservative opinion today, to avoid IRS scrutiny, is that this conclusion written in 2014 applies to proof of stake and indicates how the IRS would treat baking, validation, proof of stake. If this becomes the policy, or if this remains the policy in the United States and other jurisdictions, it's going to be very bad for proof of stake. And I'm going to explain why in a minute. First, there's the issue of, well, let me go back to that language there. So the fair market value of the virtual currency as of the date of receipt would be included in income. What that means is that block rewards, when issued or received by the validator, are income at the value on the date that they're received. Now, the first thing that this raises are some compliance and administrative burdens, which are not negligible. So, keeping with the example of Tezos and the distribution at the end of cycles, this would mean that there would be approximately 120 taxable events each year when those rewards are released into the custody of those validators. And this also raises issues about, there are also concerns there about the valuation. So if we assume that cryptocurrency remains volatile, your income on a certain day is determined by the market value on that day, and that can create additional cash flow and liquidity concerns. And the bigger picture here is, if this is the case, that means at the end of each year, you've been income according to the IRS, and that may require you to reduce or sell from your stake in order to meet that burden. The second and far more important, ultimately, implication there is that this approach leads to unfair taxation. And this gets to the concern of my presentation about getting the terminology right so that everybody is clear about what's happening and is not misled by the use of these terms like interest, dividends, or even the loose use of terms like yield, because they're misleading. The taxation here is, the problem with taxation is that because of the dilution effect of these tokens on one's stake, the fair market value of the tokens that you do receive overstates your gain. It overstates the validator's gain because it ignores the dilution effect that those new tokens have on the entire stake. Now I'm going to illustrate this. This is an image. This is a graph from some of my academic writing on this subject. But if you look at that chart and you look at the downsloping line there, in the hypothetical I gave at the beginning, I gave the example of what if there is 100% participation there? 100% participation in the network, meaning that everybody ends the year with the same stake in the network. Now, a key assumption for what you're looking at in that graph is that the network valuation stays constant, and that's important to notice. But I need to point it out because, of course, that's not the way we think of cryptocurrencies. Maybe we hope they go up, but it's important for understanding the concept I'm getting at. But it doesn't matter if we loosen that assumption because the phenomenon is still going to be the same, even if the value of the network increases for other reasons, appreciates in value, and along with it, the value of the tokens. So if you look at that downsloping line, as noted earlier, if 100% of token holders participate in validation, the gain, the actual gain to those validators will be nothing. But that's not the way the IRS would look at it under this perspective that these tokens are income when received. If we approach it from the IRS perspective there, the income, what this chart shows is the total income is there at the top. Now, I did this based on the statistics of an $800 million network value and a token creation rate, which is approximately correct for the time of writing, of a little over 5%. And what the IRS is going to see is total annual income from the maintenance of the Tezos network at about $40 million. Now, that's not the actual gain, and as we see here, I've calculated it for the data at the time I wrote this with a participation rate of about 71%. The actual gain that would be received from validators would be only about $11 million. So, so that's the basic challenge we have with taxation. Now, the solution to this in the United States and elsewhere is to ultimately tax proof of stake block rewards when they're sold and not when they are created. And this gets back to the practical advice I have, which is to avoid this reliance and using terms like interest and dividends in particular to describe what's going on with the opportunity to participate in proof of stake network. Interest and dividends sound like income, and they sound like income that would be taxed at the time it is received. In addition, even these other terms, and I actually should have put the term passive income, which is something you hear a lot with regard to proof of stake, in red, is also is something to banish from your vocabulary, because passive income includes the word income, and that's not the attitude, and that's not the idea that we want to convey, because for the reasons I've mentioned, it ends up being quite misleading, because the amount of tokens you receive is not a fair statement of the gain that's actually been received. If something's income, the general rule is it gets taxed right away. Certainly in the United States, and definitely in most jurisdictions that have an advanced tax system that is going to be looking at this type of economic activity. Now, I don't have a perfect solution for this, because the economics involved are a little tricky. They're certainly become a lot more tricky when we understand and realize the volatility involved. But as a start, the point is just to avoid the worst terms like interest and dividends, refer to them as rewards, and make an effort to differentiate between the idea of yield of tokens versus actual yield or real gain. And as one example of that, if you look at My Tezos Baker, the website there is good on this, and it emphasizes, I think it calls it nominal yield in one column and then real yield in the next. And that next, the real yield is one that takes account of the overall inflation or token creation rate to assess what the actual gain is of in that case, the delegator who's using the various bakers who are available. In addition here, with my recommendation that we focus on the terminology, this is getting something I don't have much time to get into on this presentation, but it's something I focus on in some of my writing, is what we're talking about here is the importance of the metaphors that we use, even the memes that we use, the language that we use to describe what's going on. And one thing I also propose is that we adopt the approach that validators are creating blocks. That's something we say, but they're also creating these tokens. And the reason that is important is it introduces a different approach to thinking about these tokens, not as something that are paid by a cryptocurrency protocol, but are and therefore look like something that would be income at the very moment you receive it, but instead are something that are created by people. And the reason that's important is that in tax law, generally speaking, if you create some property, it's not income until you sell it. I'll give you one example. If you were to sit down with and carve something nice, call it even a token, out of wood, and you were then going to go onto the internet and sell it, that wouldn't be income when you're holding it in your hand. This token, it's only income when you sell it. And this is so obvious, and this is so fundamental to American and I think most legal systems, that there's actually no provision in the law that states this. Although the areas, I mean, it's still mentioned in some areas, as many people know. If you mine actual gold, it's not income when you mine it. It's only income when you sell it. But this is such a fundamental principle of Western law that it's not often even mentioned. And if we encourage this view and this way of understanding these tokens as something that are created, then we could be that much closer to conveying the economic reality that they should be treated that way, and therefore taxed when they are sold. So really my point to keep this practical is just to be careful with the terminology, because it is important, and to keep a careful eye on the true economics of what you're doing, so that what you're, the messaging you're giving and that you're contributing to, and as we educate the public, is accurate and doesn't further confirm kind of the default approach of possibly the U.S. government, and certainly possibly other governments around the world, because the overtaxation involved would be significant. It could drive innovation away from those jurisdictions that would otherwise encourage it, where people are escaping an excessive regulation, or in this case, tax burden. And let's remember, this whole industry, this invention is very new. It's still impressionable. Words and metaphors and the memes we use to explain what's going on matter a lot. And so let's not confuse the public. And just as importantly, let's not confuse the government, so we can make it hopefully easier to get to the right policy result with regard to taxation. All right, I'm scrolling through here. Is this a regulatory issue in U.S. interest in generating things or securities? Stephen, I'm not let me think about that. Are we talking about mainnet or testnet incentives? I'm talking about mainnet. I'm talking about basically all proof of stake. AJ saying, if you're getting a reward, then that's a taxable event. And you may be right, AJ, under the way we looked at it and under the IRS guidance that I've quoted on the screen there. But it's not necessarily as obvious as that. Let's go back to the language I was proposing. First of all, it shouldn't be a taxable event, or at least it shouldn't be a taxable event in the way that it appears to be right now, because it overstates the gain, and that's something that we can demonstrate mathematically. The question is how we should view it, and one of the angles that I'm proposing, and with my emphasis on created property, is to frame this as something about an instance of creating something as opposed to receiving a reward from something else, from somebody else. Actually, I can't hear you.
Awesome. Well, there it is. Okay. Well, yeah. Well, thank you so much. Really do appreciate this incredible talk. Very, very valuable to all of our audience. And hopefully there's a lot more clarity around all this. And we're not going to be calling our staking earnings as dividends or interest. So that is very important. So thank you so much. Do you mind just sending us the academic papers that you had mentioned? And we will add them.
I'm going to pop in right now into the chat. You can also find them elsewhere and in my slides. And yeah, please feel free to follow up. And as I also mentioned, I've been focusing on U.S. law, but this is a global audience. So those who are interested and involved in the accounting and tax practices in other jurisdictions, I'm interested in your thoughts, and something I'd be interested in talking further about.
Fantastic. Thank you so much for your time, Abraham. Have a good one. Talk soon.